Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different information. It deals with the Fed funds rate, the housing market in terms of the housing starts, crude oil, Camco, and gold. And I think you can set up a pretty good portfolio, almost a diversified portfolio, using a few of these commodities in a big commodity bull market. Because some of them go up in the exact opposite time that the other one kind of, we'll call it, relaxes. So you can keep piling money with a strategy into one asset versus another asset. And that's exactly what I've done to some degree. And we're going to go over how these things are correlated, if there's any correlation, what does well under certain market conditions, what does well under an increasing interest rate environment versus a decreasing interest rate environment, and try to figure out what can we use as leading indicators. Like if the interest rate's going up, where should we be? If the interest rate's topped and it's about to go down, well, where should we be there? And what would be an early entry point? That's where you make all the money. Early entry points, being there first or second, whatever, being there early, and then waiting for the crowd and the money to kind of roll in shortly thereafter. So yeah, we might be partying at the party early by ourselves, but it'll come. It'll come, and we're already there, and we'll experience the entire party for ourselves. So let's dive in. I'll show you what I've got. And I know it looks really busy here. So first off, just take a deep breath. What I have is Camco at the top. The big top is Camco. We've got the federal funds rate at the bottom in the orangish here. We've got our housing starts. We've got our crude oil. And then we've got our gold at the bottom. So crude oil is the gold line. Gold is the purple line at the bottom. Now, we have these vertical lines going across. The red lines are when the Fed funds rate goes up. Fed funds rate up, Fed fund rates up, Fed funds rate up, and we just went into a Fed funds up. The green lines are where Camco went and did its bull market. The beginning of the bull market to the end of the bull market. Beginning of the bull market to the end, which I think we are still in. And then we'll look at what those interest rates look like in that cycle. So let's do some observations here. If I look at the two red lines, in between the two red lines where the interest rate went up, and not where it paused, but just where it went up, that's where we see oil go up. Oil went up there, so that definitely goes up. Gold doesn't really do anything. I don't see any correlation there. The housing starts were basically flat during this time frame from 1999 through 2000. And Camco went down during that first, we'll call it, increase in interest rates from 1998 all the way till 2000. And why am I using this? Because that was the start of the commodity bull market last time. So we had an increasing interest rate during that time frame, went down, oil went up, and gold was sideways. Looking at the other two red lines here, from 2004 all the way till 2006, we had an increasing interest rate environment, and it was flat all the way till the end of the bull market in June 2007 for uranium. So during that one, we saw a dramatic increase in uranium prices. Between the two red lines, it paused, and then we had one last little final blow off before it went into a consolidation. So the first increase back in 98, like basically 98, 99, where we had the buy point of commodities, we had an increasing interest rate environment. Camco did not do anything. And oil responded quite dramatically. The second one, oil responded dramatically. It went up a lot from the increasing interest rate environment. Oil took off dramatically. We also had uranium take off dramatically, and gold, it went sideways and it went slightly higher. So it wasn't a huge run. It looks like it started at maybe 437 and ended up at maybe 676. Well, that's a pretty good run. Pretty good run for gold. That's a pretty good run. So the increasing housing starts were also from '04, and it started to decline in 2006. And as that declined, you could see that the Fed funds rate went flat. And we saw a dramatic decline in our housing starts. One could also conclude that we had a very dramatic increase in housing starts from 1.4 million all the way to the peak of over, like 2.1 million. So we went from average to 2.1 million, and Camco went up dramatically during that time frame. So did oil. Oil did increasingly well in that environment. And gold also did well in that environment, going from 287 all the way till 664. So what I would conclude here is that the housing starts, which were the driver of liquidity in the system, the liquidity in the system comes into the system and it pushes asset prices higher because inflation is more or less putting everything into a shortage. It's saying, pull more commodities, pull more whatever. And the supply demand is the supply demand of money in the system in relationship to goods and services or the GDP. That is what is driving this last bull market in commodities. Then you had the increasing interest rates, which forced money rotation and really took off for Camco, really took off for crude oil, and took off for even gold. So that is what pivoted money, so to speak. It impacted the money flows. Then when we reached the top where interest rates basically collapsed, we saw a collapse in uranium. We had one big blow off top in oil and then a massive collapse afterwards. And then gold actually went higher. It went from 613 all the way up to $1,800, $1,900. So gold would have been the one to hold at that time. So if you were to think of a strategy and you were to look at this, you'd say, okay, as we increase in interest rates, uranium does well, oil does well, and gold does okay. Now, as we look to the right-hand side, we had a buy point. You could even say that the bottom of the market was 2016 if you're real early. That's the bottom of the bottom. We had an increasing interest rate environment in that time from November 2015 all the way to where it peaked in January 19 and then went flat. Then we had the crash there. We also had housing starts at 1.148 million to about 1.26 million. So we were in a recovery phase. It wasn't necessarily in an expansion phase yet. And we saw oil do pretty well. Oil was at $40. It peaked out at 70 and then came back a little bit to about 47. And then gold during that time frame was 1,000 all the way up to 1,300. So it wasn't a huge big move in any of the assets. They were all pretty subdued, but we had an increase in our Fed funds rate. And as the Fed funds rate peaked and went down, Camco sold off. We had our housing starts that were resilient. We were in an expansion phase of real estate already back in 2019. Before COVID, before the declining interest rates, we were in a housing expansion phase, like we were just going into it. We had oil start to eat it, like it knew something was going on, and then we had gold take off. So gold was strong from 2019 all the way to 2020. It went from 1,300 up to 1,630 in a pretty short time frame. And that was during a kind of a declining interest rate. And then the interest rate fell off a cliff when this green area and bottomed out, and gold went all the way up to 1,800, 1,900. basically that double top. Oil collapsed. So did the housing starts as we shut down the economy. And uranium collapsed too during that March 2020 timeframe. We also, they printed a bunch of money. They did QE, and I think that's why this is a little bit confusing, because QE held this thing down. Oil took off, running like a raped ape. The increasing money system here, where we should have been having increasing interest rates, but they did QE to hold it down, that lit a fuse under uranium, oil, not for gold, and the housing starts came back into an expansionary phase. 1.7 million, 1.8 million. Now, as interest rates have moved up, we've had a dramatic increase in interest rates. Dramatic. And under an increasing interest rate environment, as we have seen in this example, this example, this example, oil's gone up in every single increasing interest rate environment, except for this past, in May, June, we peaked in 2022. And what is the difference there? What happened during that summer? They released the Strategic Petroleum Reserves. And the reason I want to go over this is because someone said that the Strategic Petroleum Reserves, that commodities all went down and the Strategic Petroleum Reserves were not the reason. Yes, it was. We had liquidity in an increasing interest rate environment coming in. This would have spiked up to 150, 160 is my guess, if they had not released the Strategic Petroleum Reserves and basically wash out the markets with more oil. Gold went down in that environment, just like we would predict based off of every increasing interest rate period from 1999. Increasing rate, not much of anything. Increasing rate, it went up some. Increasing rate went up some. And then increasing rate, it went down a little bit here. But it also went down with our housing starts. Housing starts went up here. It was basically sideways. So, is this a reliable enough indicator to use, the Fed funds rate? It's one example that we could use. It's one thing that we could look at and see what's going on. And I think gold could be front running what could be a flattening or loosening in the Fed funds rate, potentially. And we're seeing uranium pull back as well a little bit in the short term. So I wanted to go over this, show you guys kind of how this is all correlated. So usually oil does real well in an increasing interest rate environment, which is inflationary. Inflation hedge, which is oil, or I should say the benefactors, because you've got an imbalance between GDP and the M2 money supply. When that goes up faster than GDP, money has to go into energy to kick it all on to produce more energy to have an accompanying GDP growth. But this last cycle is different. We can see it pull on back, even though the interest rates are going up. Are they at a level that's unsustainable? I don't know. We'll see. We'll see. But that is something that I noticed. I'm still very much a bull in every single one of these categories I'm covering, which is uranium, oil, gold, silver, platinum, all those. Still a massive bull. Copper, zinc, nickel, natural gas, everything. But hopefully you guys have a little bit better understanding of kind of the relationships here, looking at it. And, are we going to see a pullback in the Fed funds rate? If we see a pause and then a pullback, where do we want to be? What's the answer there? I would think precious metals. And precious metals are starting to strengthen here. So we could see a short-term weakness in some of these areas if the Fed pauses and lowers at some point. Or another thing is they may have to increase the Fed funds rate if China reopens and we get upward pressure in crude oil. The Fed funds rate may not be the leading indicator, may be lagging behind oil. Oil kind of gets moving, and then the Fed funds rate chases interest rates. Interest rates chase oil or inflation. So it's an interesting dynamic, but if we see that kind of top off, if we think we're going to come back down, usually when they, what we'll call, do more easing in the cycle, gold usually does very well. So gold does well in the easing, in the increasing interest rate environments. Gold still does well, but it underperforms oil. We're also seeing that the gold to oil ratio is favorable for oil for gold right now. Gold's been going up. Oil's been pulling back. We'll see if that ratio continues like that. I'm still very positive on oil. I think we're going to bottom at some point here. I don't know exactly when. And then if China reopens, this is going to be fun. But that's what I've got for today, guys. If you guys need help in this commodity bull market, definitely sign up for the finding-value.com. I still have discount on. You can use discount in the coupon code and get a discount for the Platinum membership. We have a Platinum question and answer session Sunday, 5 p.m. Mountain Standard Time, if you want to join us this next weekend coming up. I know this is releasing on Monday, but that's just a reminder for all the people that are there. If you like the content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.